Welcome to the Wealth Continuum, where we decode the signals the mainstream financial media misses. After a strong start to the year, the precious metals market just experienced something that has shaken even the most seasoned traders. But here's what they're not telling you. In the last 24 hours, gold traded through a nearly $500 range, plunging to $5,100 before fighting its way back above $5,300 and briefly touching $5,600 as a new all-time high. Silver experienced similar whiplash, diving to 106 before rallying back to 115. Comment below if you're moving money this week. While some will call this a breakdown, the aggressive buying off the lows tells a different story. This was a liquidity flush, a violent clearing of overleveraged positions that found willing, sophisticated buyers at every support level. When you see this kind of buying pressure during a sell-off, it's not panic, it's accumulation. The catalyst? The Federal Reserve. This week, the central bank held rates steady, but something unprecedented happened. The vote was 10-2, with Governors Christopher Waller and Stephen Miran dissenting in favor of an immediate rate cut. Stay with me because the next part is crucial. The Federal Reserve doesn't do split votes. They operate on consensus. They telegraph moves months in advance. They present a united front because credibility is their only real tool. When governors publicly dissent, putting their names on record for immediate action, it signals something is breaking beneath the surface that official statements aren't acknowledging. These aren't fringe voices. Waller and Miran are serious economists with access to data we never see. Their votes are telling us the system is becoming too fragile to handle restrictive rates much longer. The stress in credit markets, regional banks, commercial real estate, and household balance sheets is reaching critical levels. Hit like if the Fed is losing control. Meanwhile, Chair Powell keeps using the word stabilizing to describe the labor market. But reality tells a different story. This week alone, Home Depot and Comerica Bank announced major headcount reductions. These aren't startups. These are blue-chip, investment-grade institutions cutting jobs while the Fed talks about stability. And it gets worse. U.S. household energy bills just hit a 3-year high. While the Fed maintains restrictive policy to fight inflation, American families are paying more than they have in 3 years just to keep the lights on. This is where it gets really concerning. Buy now, pay later usage is exploding, but not for luxury items. For essentials, recent data shows 25% of these users are financing utility bills. The fastest growing category is medical and dental expenses. People are splitting payments on electricity bills and healthcare. This isn't an economy adjusting to higher rates. This is household financial stress at critical levels. Share this with someone who needs to hear it. Now, about those corporate layoffs. Powell dismissed them by pointing to the unemployment rate. But here's the pattern veterans recognize. We saw a similar wave last October. Companies announce layoffs during earnings season because it makes stock prices pop. Investors reward efficiency and cost cutting. But here's what happens next. These workers typically get 6 to 9 months of severance. During that time, they don't show up in unemployment statistics. They're cushioned. But when that severance runs out, when they start actively seeking work in a tight market, that's when unemployment catches up to reality. The Fed is relying on lagging indicators while leading indicators flash red. Corporate America is cutting headcount, households are financing utilities, energy costs are spiking, and the central bank is using backward-looking data to justify inaction. You need to understand this before I show you what's next. Let's talk about the credit market time bomb that keeps risk managers awake at night. Billions in commercial real estate loans are maturing this year. Office buildings valued pre-pandemic are worth significantly less in a world of remote work. The question isn't whether there will be losses. It's when banks finally recognize them. For years, we've heard about extend and pretend, banks rolling over loans, delaying the reckoning, avoiding markdowns on real estate. But we're seeing increased transaction volumes in office properties. That means price discovery is beginning. When properties actually trade, banks can't pretend values held steady. They face reality. And reality means taking losses they've been hoping to avoid. Hit, like if regional banks are hiding losses. Banking regulators have been extraordinarily generous, allowing banks to recast bad loans and buy time. This applies to commercial real estate and consumer loans, personal loans, auto loans, credit cards. The same extend and pretend behavior across balance sheets, all betting the Fed will cut rates before chickens come home to roost. But there's another layer. Private credit markets are showing stress. After the zero-rate era, companies that couldn't access traditional lending turned to private credit funds. These funds raised capital from pensions and endowments chasing yield when safe assets paid nothing. Private credit was built for low rates. The models, return assumptions, and risk frameworks all assumed refinancing would always be available at reasonable rates. That assumption is being tested now. If defaults accelerate in private credit, it bleeds through to public markets immediately. Investors become defensive. Risk-off dominates. This is where it gets really concerning. The split Fed vote tells us some governors see this building and want to act preemptively. They want rate cuts before credit markets break. But Powell and the majority are waiting for unemployment to force their hand. Meanwhile, China issued new regulatory guidance on mutual recognition of funds, reportedly tightening restrictions and limiting exposure to U.S. assets. If foreign capital faces restrictions, exactly when we have heavy treasury issuance, exactly when the Fed maintains restrictive policy, exactly when domestic buyers become defensive, you create conditions for volatility to spill from metals into bonds. Comment bonds if you think treasury volatility is next. Liquidity is what keeps markets functioning. When it dries up, when spreads widen, when large orders can't execute without moving prices significantly, that's when you get dislocations, flash crashes, $500 swings in a single session. Stay with me, because this next part is crucial. This week's gold volatility marked the 10th largest single-day rally in history. We're living through extraordinary times. This is parabolic price action that attracts momentum traders, retail speculators, and leveraged funds all chasing the same bet. When markets go parabolic, they need to breathe. Healthy bull markets climb walls of worry. They shake out weak hands. They create doubt precisely when fundamentals remain intact. That's exactly what we witnessed. The sell-off magnitude suggests forced liquidation, margin calls, overleveraged positions stopped out. When taxi drivers ask about gold hitting 10,000, when neighbors who've never owned an ounce suddenly have opinions, those are sentiment extremes that precede corrections. But here's what they're not telling you. Sentiment extremes don't invalidate fundamentals. Yes, retail was euphoric. Yes, positioning was stretched. Yes, the market needed to purge leverage, but the underlying drivers haven't changed. Global central banks keep accumulating gold at record paces. Geopolitical tensions keep escalating. Military buildups are accelerating for the first time in decades. Currency debasement continues. Real rates remain negative in most developed economies. A $500 swing doesn't change any of that. There's another angle, the dash for cash. When tech stocks sold off sharply, when growth names saw significant drawdowns, margin calls cascaded through the system. To meet those calls, you sell something. You sell winners. You sell liquid assets. You sell gold and silver. We saw this during the oil collapse into negative territory. Margin calls were the catalyst. Overleveraged positions in one market forcing liquidations in unrelated markets. The financial system is interconnected in ways that don't show up until stress reveals them. This explains why gold, a safe haven, can paradoxically sell off during stress. It's not lost faith, it's needing dollars immediately for margin requirements. Gold is one of the most liquid ways to generate those dollars fast. You need to understand this framework before making your next move. One factor distinguishing this gold bull market is unprecedented central bank buying. Not jewelry demand, not retail investment, not institutional allocation. This is sovereign nations systematically diversifying reserves away from dollar dependence into physical gold. Why does this matter? Central banks operate on different time frames than private investors. They don't chase momentum. They don't panic sell on $500 down days. They accumulate for strategic reasons related to monetary sovereignty and geopolitical positioning. It's like when China adds to gold reserves, they're not thinking about next quarter. They're thinking about reducing vulnerability to dollar weaponization. When Russia increased holdings before recent events, that was strategic positioning for restricted dollar access. When Turkey, Poland, Singapore accelerate accumulation, they're betting on the future monetary system structure. Their buying provides a fundamental bid that wasn't present in previous cycles. So where does this leave investors? It depends on your risk appetite and time horizon. If you can stomach $500 daily swings, if you understand parabolic moves include violent shakeouts, then corrections represent opportunity. Smart money accumulates on weakness when fundamentals remain intact. But if capital preservation is your priority, if you can't afford 30 or 40% temporary drawdowns, then proper hedging is essential. Reduce position sizes. Use options to define risk. Take profits on portions to secure gains. One strategy experienced traders use: take your cost basis off the table. If you bought at $3,000 and it's now $5,300, sell enough to recover initial investment and let the rest ride with house money. This doesn't maximize theoretical gains, but it eliminates actual loss possibility and reduces psychological stress dramatically. Hit subscribe if you want the follow-up analysis. Let's step back from daily volatility, from hourly swings, from breathless commentary. Look at the forest, not the trees. We're living through a fundamental repricing of monetary reality. For decades, the system operated on assumptions. The dollar would remain the unquestioned reserve currency. Treasury markets would stay deepest and most liquid. The Fed could manage cycles through rate adjustments. Those assumptions are being tested in real time. Gold at $5,300 isn't just about inflation or yields. It's about central banks globally diversifying from dollar dependence. It's about geopolitical fragmentation creating alternative systems. It's about recognizing that infinite money printing has consequences that eventually manifest in currency values. When your taxi driver asks if gold is hitting 10,000, yes, that's a sentiment indicator suggesting near-term positioning might be stretched. But it also shows mainstream awareness finally catching up to what precious metals investors understood for years. The monetary system is changing, and that change has only begun. But here's what they're not telling you about market psychology. When gold rallies from 3,000 to 5,000 in months, you attract different participants at each stage. Early buyers were contrarians. They bought when everyone was skeptical, when gold was called a barbarous relic. These buyers have conviction based on fundamental analysis. They understand monetary history. Middle stage buyers are momentum followers. They buy because price is rising. They don't necessarily understand why, but they see the trend and want in. Late stage buyers are pure speculators with no conviction. They heard from neighbors or social media that gold is mooning. They use leverage to maximize returns. No risk management. No understanding of what they own. When the market corrects violently, late-stage buyers panic first. They sell at the worst time because they never had conviction. Momentum followers get nervous. Some hold, many take profits. Early buyers? They're holding or adding because their fundamental thesis hasn't changed. This cycle repeats at every bull market stage. Understanding where we are in this psychology helps you make better positioning decisions. Here's something most don't understand. The vast majority of gold trading happens in paper markets. Futures, options, ETFs, certificates. Very little physical metal changes, hands relative to notional value traded. This creates interesting dynamics. When everyone wants to buy paper gold simultaneously, prices rise quickly because there's effectively unlimited supply. You can create as many futures contracts as there's margin to support. But when everyone wants to sell simultaneously, liquidity evaporates just as fast. The $500 swing was primarily paper market phenomenon. Physical dealers will tell you premiums actually widened during the sell-off. People wanting physical metal had to pay more, not less, even as paper prices crashed. That divergence tells you something important about what's happening beneath the surface. Stay with me, because this is crucial. The paper market sets price, but physical demand sets the floor. When paper disconnects too far from physical reality, arbitrage opportunities emerge and force convergence. But short term, you get wild swings that don't reflect actual metal supply and demand. Let's put this in perspective. $500 on 5/3/1500 is roughly 9%. Significant, but not unprecedented in commodities or gold's history. During the 1970s bull market, gold regularly had 5 to 10% daily moves. During the run from 100 to 850 between 1976 and 1980, there were days with $50 or $60 moves, which percentage-wise was even more extreme than what we just saw. Volatility is the price you pay for outsized returns. Want stable, predictable returns? Buy treasury bonds? Want potential for dramatic wealth preservation during monetary transitions? Except the path won't be smooth. Investors who made generational wealth in the 1970s weren't ones who traded every swing. They understood the thesis, sized positions appropriately, and held through volatility. Comment below, buying the dip or waiting for clarity. While everyone focuses on metals volatility, the bond market sends its own signals. Treasury yields have been remarkably stable despite everything. The 10-year trades in a narrow range even as inflation stays sticky. The Fed maintains restrictive policy, and deficits keep expanding. Some interpret this as markets believing the Fed has control, that inflation returns to target, that we achieve soft landing. But there's another interpretation. The bond market might be saying growth will slow significantly. The Fed will be forced to cut much more aggressively than priced, that we're headed for recession, not soft landing. If that's correct, it actually supports the bullish gold case. In recession with aggressive Fed easing, real yields collapse, and gold thrives in negative real rate environments. So the bond market's calm might be confirming what gold already prices in. We can't discuss gold without acknowledging the geopolitical backdrop. We're living through increasing great power competition. The post-Cold War unipolar moment is over. We're entering a multipolar world with different power centers, pursuing different objectives. This matters because in a multipolar world, trust in any single currency or central bank diminishes. Countries want optionality. They want to reduce dependence on systems that could be weaponized. Gold provides that because it's no one's liability, can't be sanctioned, can't be frozen, can't be inflated away by foreign policy. The military buildups worldwide aren't just about immediate threats. They're about preparing for a world where the rules-based order looks very different than the past 30 years. In that world, hard assets that can't be confiscated or devalued by decree become increasingly valuable. If this week proved anything, it's that the era of stability is over. The era of predictable central bank policy. The era of assuming markets always have liquidity at reasonable spreads. That era ended. We're entering a regime where $500 daily swings might become normal, where split Fed votes indicate genuine uncertainty, where corporate layoffs accelerate while statistics lag, where households finance utilities while the Fed talks stability. Risk management matters more than prediction. Position sizing matters more than perfect entries. Understanding what you own and why matters more than chasing tips. This isn't your grandfather's market. This isn't the stable world of the 90s or 2000s. This is where rules are rewritten in real time, where yesterday's assumptions become tomorrow's liabilities, where the only constant is change. The wealth continuum isn't a straight line. It's a journey through volatility, through uncertainty, through periods where headlines scream panic but fundamentals whisper opportunity. Stay focused on what matters. Stay disciplined. Remember that traders who survive and thrive aren't the ones who predict every twist. They're the ones who manage risk, maintain perspective, and understand that volatility is the price for long-term returns in assets that preserve purchasing power across generations. Let's talk implementation. If you're convinced precious metals should be part of your portfolio, the question becomes how? Physical metal, ETFs, mining stocks, futures, options. Each has trade-offs. Physical has no counterparty risk but involves storage costs. ETFs provide liquidity and convenience but introduce counterparty risk. Mining stocks offer leverage to metal prices but carry company-specific risk and equity correlation. Futures and options provide maximum leverage but require sophisticated management and can result in total loss. Most investors are best served by combination approaches. Core position in physical or highly liquid ETFs for the monetary hedge, perhaps exposure to quality miners for upside potential. And for sophisticated traders only, tactical derivative positions for short-term views. The worst mistake is going all in on any single approach, especially using maximum leverage because you're convinced about what happens next. Markets can remain irrational longer than you can remain solvent. Position sizing and risk management aren't buzzwords. They're the difference between surviving to see your thesis proven right and being forced out at the worst possible time. Share this with someone who needs perspective. Silver deserves deeper discussion. It moved from 106 to 115, roughly 8%, similar to gold percentage-wise. But silver has dynamics, gold doesn't. It's both monetary and industrial. Significant industrial demand from solar, electronics, medical applications, manufacturing. This dual nature means silver responds to monetary factors like gold and industrial factors like copper. If we're headed toward recession, industrial demand could weaken, pressuring prices down. But if we're headed toward aggressive monetary easing with negative real rates, monetary demand could overwhelm industrial weakness. The silver market is smaller and less liquid than gold, which means moves in either direction are more extreme. Some view silver as leveraged gold. When gold rallies, silver typically rallies more. When gold corrects, silver corrects more. This makes silver appropriate for higher risk tolerance investors who believe in precious metals but want more upside potential in exchange for accepting more volatility. Every major bull market in history had moments where everyone thought it was over, corrections that seemed to invalidate the entire thesis, days where narrative shifted from unstoppable momentum to complete collapse. Yet the greatest bull markets ultimately resumed their trajectory and exceeded even optimistic targets. The key is distinguishing corrections within bull markets from actual trend reversals. Corrections are sharp, violent, emotionally difficult. They shake out weak hands and reset sentiment, but they don't change fundamentals. Trend reversals happen when underlying drivers that created the bull market change. Have the fundamental drivers changed? Are central banks suddenly stopping gold buying? Are geopolitical tensions suddenly resolved? Is the government suddenly balancing budgets? Is the Fed suddenly raising rates to 10% for years? The answer to all is no, which suggests what we witnessed was a correction within an ongoing bull market, not a trend reversal. That doesn't mean the path forward will be easy or that there won't be more corrections. It means the fundamental case for precious metals exposure remains intact. Now let's address what really happened during this volatility from a market structure perspective. Most gold trading happens in paper markets where notional value vastly exceeds physical supply. This creates situations where paper prices can disconnect from physical reality short term. During the sell-off, physical dealers reported premiums widening. People wanting actual metal paid more even as paper crashed. That tells you sophisticated buyers differentiate between paper price and physical value. They use the paper sell-off as opportunity to acquire metal at temporarily depressed prices. Understanding this structure helps explain how $500 moves happen so fast. It's not just organic supply and demand, it's algorithmic trading. Futures rollovers, ETF arbitrage, option hedging, all interacting in ways that amplify moves in either direction. The investors who made generational wealth during previous precious metals, bull markets shared common traits. They weren't the ones who traded every swing. They understood the fundamental thesis. They sized positions to survive worst days so they could benefit from best days. They maintained discipline when headlines screamed to do something different. The 1970s gold investors who succeeded bought conviction, not on charts. They recognized what happens when central banks lose credibility, when currencies debase, when geopolitical order fragments. They held through volatility that makes today's swings look tame. The wealth continuum represents building and preserving purchasing power across generations, not chasing daily movements. It's about understanding that monetary systems evolve, that paradigms shift, that what worked for the past 40 years of declining rates and expanding globalization might not work for the next 40 years of rising rates and fragmenting world order. As we look forward, expect continued volatility. The fundamental drivers remain: central bank buying, geopolitical tensions, monetary system transition, currency debasement, negative real rates. These operate regardless of daily price action. But the path won't be smooth. There will be more days like we experienced, moments when sentiment gets euphoric and corrections become necessary, periods when narrative shifts and weak hands get shaken. The investors who navigate this successfully won't be ones who perfectly time every swing. They'll be ones who maintain perspective, who remember short-term volatility as noise, but long-term trends are signal, who understand corrections are features of bull markets, not bugs, who size positions to survive worse days to benefit from best days, who keep eyes on big picture while headlines scream about daily action. The $500 swing this week will be remembered as one of those moments that tested conviction. In real time, it felt catastrophic to anyone over-leveraged or who misjudged risk tolerance. But when we look back months or years from now, it will likely be viewed as just another volatile day in a much larger trend. What matters isn't predicting every move. It's understanding the big picture, positioning appropriately for personal circumstances, maintaining discipline to stick with your plan when markets scream to do something different. That's how wealth gets built and preserved during monetary transitions. This is the wealth continuum. Thanks for watching. Until next time, stay informed, stay positioned, and stay focused on the signals that matter.